Okay, as people are coming, let us resume our lectures this week. This time we are going to consider monetary issues from a different point of view, from the point of view of Latin America, Mexico. And I should say specifically for a Russian part of our audience that Mexico is often neglected country in Russian political and economic discourse. However, the patterns of our development, also in monetary situation, in the 20th century, in the early 21st century, of course, with all the differences and so on and so forth, but the patterns of the development of Mexico and Russia, starting with the civil war in the early 20th century, with the one-party rule for a larger part of the 20th century, with monetary and economic development problems which we experience right now. So I say these patterns are not altogether different, and therefore, specifically for a Russian part of our audience, I think the view provided that Professor Levy of Mexico University would provide us with would be especially important and useful, I believe. So let me introduce to you Professor Noemi Levy, who is with us now from Mexico, from Latin America, and let us begin our lecture. Please.
Okay. Good morning. Thanks for the invitation. It's a pleasure to tell you about how we see things from here. And I hope my English will be understandable. If not, please stop me at any moment. I'll try to do it sort of slowly. And if I may, can I share my screen now?
Yeah, try again, please.
Are you able to see it now? Can you see it?
Yes.
Okay. So I name it monetary theories in countries with limited financial market. I think this would be a major feature for main developing country, particularly in Latin America. What I want to do today is three things. Very, very briefly, I want to see the quantitative theory of money to the Taylor rule. Then I want to have a a brief outline of Keynes, Kalecki, and Minsky, and the circuitist in terms of the creation and the destruction of money and the role of financial institution. And at the end I will speak by itself to the monetary circuit theory. So this is the outline. Let me start now with the issue in which money is neutral and exogenous. Money is determined here by outside the economy, by the central bank. Here we got the quantitative equation, and the only thing I want to highlight here is that being V and Q, which is the velocity of money and the production of stable, M affects P. What does it mean? That inflation is a demand determined variable. They reckon that the rate of interest is a real variable determined by saving and investment. Full employment is attained an equilibrium rate of interest. And what is important here, to my knowledge, is that governments are the only agent that can be in debt with the central bank, which means that can through credits to government can be created money. I think this is important, and this has been said. This has been characterized this view. I don't want to spend much time in this because it's not very used today. It's just an antecedent of what neoclassical theory is. And then we go to a much nearer theory of what's going on today, which is money is neutral but endogenous, and the famous Austro-German economic theory, Wicksell and the others that pose the financial cycle. As everyone knows, in this theory, central banks determines the money interest rate, and commercial banks take the price of the interest, and a price taker, and impose it to lenders. How the monetary interest is determined is set around the natural interest rate. The natural interest rate is when investment equals to savings, and the difference, which is leads to financial cycle. Very easy. When the monetary interest rate is below the real interest rate, lending will go up, investment will go up till it equates, but since it's not now the real interest rate, investment can go above a saving. Gold reserve in this theory would go down, accumulative inflation will take place, and there will be a need to increase monetary interest rate. More or less happens the same if monetary interest rate is below the real interest rate. But what is important here for us is what's the Taylor rule that dominates somehow our economy. It's a monetary rule that functions around a real natural interest rate determined by inflation gaps, which are this, and productive gaps. So very easy, monetary interest rate given an inflation, a real and an objective natural interest rate, and the gaps is the way monetary interest is determined. And if there is no monetary gaps, no productive gaps, you will get that monetary interest rate minus the existing inflation needs to be real interest rate. And in this sense, yeah, you should get equilibrium. Well, they put the Nairo theory, a lot of things, but this is more or less the basis of it. Now, in our economies, you cannot determine the interest rate without looking what's going on with the exchange rate. This is particularly important since economies has opened up, since globalization arrived to our economies in the 1990s. And in this sense, well, I would say that exchange rate have always been very important in our economies because we are dependent on imports. I will speak a bit of that tomorrow, but the only thing I want to say today that the exchange rate plays an important role in developing economies, and today is determined by capital flows, which means by interest rate differential, that the theory discusses it as the uncovered interest rate parity. What does it mean? That there needs to be a big differential between the interest rate, the domestic interest rate and the foreign interest rate, in order that capital inflows will come into the country and the exchange rate will be stable. Yeah, for instance, what was it Thursday? well, obviously we have the same problem as everyone else, every other country, that inflation is going up, and they raised the monetary interest rate by about 25 points, and we have today a monetary interest rate of 5% against the US, which is between 0 and 0.25. It's the way to stabilize the exchange rate. This is a major issue in our economies. What are the problems with the Taylor rule? Well, nobody, it's very, the way that they calculate potential income is very dodgy, and under heavy discussion. What's the inflation objective? Nobody knows very well how it's calculated, and the same thing can be said about the natural rate. What it really happens, especially in countries with deep financial markets, that the Taylor rules guarantees floor yield rates in the capital markets and sets out let me put the conditions for financial inflation. This was the discussion in the 2000, yeah, that when Bernanke didn't want to put up the interest rate, because it said we only need to put a floor interest rate to bonds and securities, and let the market determine the upper interest rate, the upper rates. What are the problems in developing economy? There are lots of writings. Calvo, for instance, 2000, the fear to float syndrome in Latin America. In this sense, the problem of the Taylor rule, at least in Latin America, that it needs to set an intermediate objective, exchange rate stability, because there is a magnified pass-through effect to domestic prices from foreign prices, obviously. What does this mean? That important prices of intermediates and final good pushes up domestic prices more than proportionally in our economies, and also our economies are unable to substitute imported goods for domestic production. So it is difficult, yeah, in our economies, yeah, the issue of exchange rate. I would say this is the discussion today that has been put forward by Calvo and has taken by some economists in Latin America, that in Mexico particularly, that we prefer to have a stable exchange rate, because it doesn't work to industrialize the domestic economy. This was a discussion taken up by ECLAC in the 1940s, and the dichotomy center-periphery true, and they put forward the deterioration of the terms of trade. What does it mean? There is a structural current account deficit because of peripheral economies specialization, mainly raw materials in those days, and there was a requirement to import capital and intermediate good. These economies, therefore, are import and export price takers, lack technological advances to industrialize their economy. And this has been the case in the last three models that has been dominant in Latin America. The exchange rate, the other discussion is that the exchange rate doesn't respond to the uncovered interest parity theory, because capital flow are not always elastic to the exchange rate movement. There is a famous article by a Chilean, I don't remember the name now, Goodbye Financial Repression, Hello Financial Instability, at the end of the 1980s. I think he wrote it in Oxford, yeah, resembling what was going on in this part. In the globalized period, a central bank's intervention takes place through higher external reserve, direct intervention in the exchange rate market, and sterilization mechanism that limits the monetary base. As you can see, therefore, the exchange rate is a major issue in our other economies, and this what enables the Taylor rule to do their job. Let's go to the opposite paradigm, which is much more interesting for us, in which is argued that money is endogenous and non-neutral. Here, the relation saving investment is replaced by finance is first, which is required to make investment spending from where it rises savings, the famous fees argument. In this context, money is created by banks and guaranteed by state money, or as Kaletsky argues, it responds to industrial liquidity needs. In somehow, the circuities, for another view, also would argue in the same vein. In terms of Kaletsky, here, financial market redistribute unused money among capitalists. I will come back to this in a moment. Money creation takes place through different means, the famous circular flow, Kaleckian circuities, through banks backed by financial market, the famous funding mechanism of Keynes, or financial innovation, as Minsky put it forward. What are the main assumptions here? Investment determines saving, and the equality is ex post instead of ex ante. Money is not neutral, and the rate of interest is a monetary variable. The velocity of money or of deposit is not fixed, something that Keynes argued through speculation, and Kaletsky also argued independent of the argument of speculation. I will come to it in a moment. What are these descents within this group of theories, that whether it's a function of state money, financial innovation, or changes of interest or velocity of deposits. So money and endogeneity can be seen through different ways. How interest rates are determined, Keynes put it forward through the liquidity preference theory, through which uncertainty plays a major role and drains liquidity out of the system. This, I think, is the main point of Keynes. Minsky explains it through financial instability hypothesis, and Kaletsky, sorry, here it's okay, I put it back, argues that it's a distributed values, and the increasing risk theory is put forward for him. For the circuit, it is also a distributive variable determined by the central bank, but they argue that either the interest rate is an administrative variable that is set by someone, ergo central bank, or it's an infinitively elastic price, which doesn't move according to the amounts of the volumes of money. What can we say in terms of this theory in developing countries? In the easy period, which for us is industrialization by substitution and imports, before the 70s, sort of 1940s, 1970, when Latin America industrialized mostly, money depends directly on the state money, and credit to banks and to government are the main forms of issuing money. And capital markets in this context were very feeble, almost in existence. What happens? What can we say about the globalized periods? Money is related to foreign reserves. This is the case, obviously, of Mexico, Brazil, Chile, coupled with sterilization mechanism, in which international capital markets play a key role in liquidity provisions at the expense of public costs. This is very interesting. At least there are some papers on Brazil, and I have written something and others in terms of Mexico, how the dependence on external reserve makes the economy to work pro-cyclical. It means that if we are in recession goes, spending goes down in terms to keep the international inflows coming in, which means stopping economic activity. This is the issue of not being able to produce finance in money, in domestic money. Is there any question? If not, I will go into the different authors to explain their particularities and how we see it from here. Can I continue?
Yes, please.
Okay, so I will start with Keynes very briefly, in which I would argue that for him, investment is a function of demand, the demand price, which is the price of financial instruments, which resembles the future profits of the firms in today's prices, which is the famous demand price, the supply price, or alternative, the marginal efficiency of capital and long-term interest rate. What is the main argument? Finance will be available if the demand price is above the supply price, because there will be returns. This will let investment spending to go up. If investment spending goes up, salaries increases, profit increases, income increases, and real saving is produced. The main issue here is that real saving needs to be transformed into financial savings in order to pay credits, or in order to produce long-term finance. So the key issue, according to our view, in Keynes, is that real saving need to be transformed into financial saving that it's bonds and share that will pay back bank credit. And it depends in the expectation of long-term interest rate. This is all the discussion of Keynes, the liquidity prefect motive that has been put in the famous chapter 12 of the general theory, that actually has been very criticized, not only in its time by Kaletsky, but it's the main criticisms also that Minsky has to Keynes, that when he said that Keynes never developed the issue of finance in a complex financial market. It's a very nice paper by Minsky, 1990, in a first streak, I think it was towards Caldo. Well, obviously Keynes, when analyzing all this issue, is thinking of an Anglo-Saxon finance system. What does it mean? I will go again back to it tomorrow, that banks provide short-term credits and capital markets long-term finance. This is a financial organization that mainly prevails in the US and the UK. In bank-based system, when capital markets are very weak, commercial bank provides credits that are what I call compensatory mechanism, which means mechanisms put forward by the state, like public banks or development banks, public trusts, and monetary policies that guide credit to specific sectors, and the government takes very much interest and provides the resources to develop these sectors. Here, the central bank administers liquidity. It can be either through what we called here, I will go again, sorry, tomorrow on that, legal reserve requirements during the industrialization periods, or also it could be done through taxes on unused money balances. This is, again, Kaletsky's proposition that in our economy certainly doesn't hold because our tax is low and almost nobody, big companies avoid it legally and unlegally. The liquidity preference plays a key role in closing the financial circle because it's, as I said, it's determined by present expectation of future interest rate. If liquidity preference is high, long-term interest rate expected to rise, the price of bond expected to fall. So savings are not real savings, are not transformed into financial savings, and back debts are not cancelled, and it can take an economic downturn. Keynes breaks here the direct relationship between interest and investment through speculation. This was a big problem that he had after the 1929 crisis, how to explain that interest rate went down, but investment didn't go up. And I think he did it through this argument of speculation. Conclusion of Keynes: government need to guarantee full employment and investment spending. This is the big issue of fiscal policy. The market cannot, the monetary policy cannot provide by no means full employment. And his other argument in this sense was that the rentier payments need to be limited. Owners of capital need to be, their profits need to be reduced. From here goes a very interesting discussion about the Passinetti fair rate interest rate, Smithing, a Canadian economist, small real interest, and the Kansas City zero interest rate by Ray, Kregel, and others. So this would be my argument in terms of what Keynes proposed, and showing that I think the important issue of Keynes is that the monetary policy cannot by no means guarantee full employment. Here we go to the our second preferred author, which is Kaletsky. Money here is very different, is defined as the money of capitalism. This part I took from our dear friend Jan Toporowski's book, which will come in January. I could read the preliminaries. And here is argued that higher volume of income is met by changes in the rate of interest or the velocity of money. The supply of money is elastic because capitalists start the circuit with money. This is the base, our very important issue that put forward Kaletsky. And according to him, the rate of interest is a monetary variable that brings the money markets, the different money markets, into equilibrium and equates new financial needs between different markets. The main problem, according to this author, of economic growth is the excess of liquidity saving. That is the amount of money that doesn't go back, that's not used in capitalist spending. In developing economies, idle money has a major impact because it dollarizes our economy. Or as Caldor in 1959, in a very nice paper on Chile, said that the main problem is that the capitalist class is using all the profit for luxury consumption, usually from imported goods. And in this sense, taxes on unused monetary balances are almost inexistent and needs to put into operation. And the government can spend as much as it wants, which was the case of Chile when he wrote this paper. But if capitalists don't send back all the profits to the capitalist circle, the productive circle, economic growth will be very, very feeble, which was the case of Chile in that period. What are the main assumptions? And here is very important. Capitalists earn what they spend and workers spend what they earn. That means that capitalists don't decide over profit, decide over spending. The causality goes from capital spending, i.e. from investment and capitalist consumption to gross profit. And here it is important how profits are determined. He put forward 3 sectors. I won't go very in detail in this discussion because it can take me too much time. But what I want to highlight is that there's 3 sectors there where is produced capitalist goods, and workers' goods. And what he argues is that in the sector where is produced workers' good is determined by the sector that produces capital goods and consumption for capitalists. In this sense, section 3, which is workers' good, production is determined by wage levels of the other sectors. Therefore, profits in this sector is determined by wage 1 and wage 2, and workers spend what they earn. What is the main problem in developing countries? That the sector that produces capital goods, which is the more dynamic sector, has been almost inexistent, not only today in this open economy, but especially in the industrialized period. Capital goods and intermediate goods have been historically important from developed countries in this part of the region. The second big assumption of Kaletsky is that in the increasing risk concept, in which oligopolistic structure dominates and there is an equal distribution of firms' external finance. Here, the famous phrase of Kaletsky, the most important prerequisite for becoming an entrepreneur is the ownership of capital. Therefore, firms with higher size get higher saving and higher access of credit. Here, the argument is that firms' external capital is finite. You cannot get whatever you want, and because it's subjected to increasing risk. And there's a very interesting discussion of what increasing risk means. Very briefly, again, the greater the investment in relation to entrepreneurial capital, greater the risk in the event of unsuccessful business venture. That is, you cannot have all your money in one venture, in one investment spending. You have to have it spread in various, and even have not only investment in real capital, but also in financial capital. And the other thing is, the heavier the borrowing, the greater is the danger of bankruptcy, and the need to pay external debt not related to income result. What does it mean? If you get indebted in bank credits, it doesn't matter what happens in the real economy, you have to pay it, even though you are in a bankruptcy. This is the case of bank credits. Well, developing economies, capital markets is weak again. There is a lot of unused money balances which don't circulate to other capitalists. I would say this is the main problem. And here just to finish this part, the rate of interest is a distributive variable, does not affect the amount of investment, but it can modify its composition. If investment is financed by liquid reserves, it means that one capital uses its reserve, this would go to profits of other capitalists, raise their liquid reserves, and pass on. If use bank credits, investment will expand, saving will expand, so as bank deposit of old economy. And this is interest here because the investment capitals are able to float bonds in the same extent to repay credit. So you don't get problems from the monetary sector. And I think with Keynes, he also agrees that the monetary sector will provide liquidity if there is capitalist spending. Monetary circulation is the way that money circulates, and the velocity of money guarantees liquidity. I think here the most important thing is that production is determined by demand and can be limited by income, but it cannot be frustrated by a shortage of liquidity. I think this is very important for our economies. The developing economies in our cases suffer from inelasticity of supply of basic necessities. Higher wages in this sense can lead to higher inflation because of supply shortages. Government needs to put in circulation idle funds and prevent luxury consumption. This is very true today. The problem is a lack. The inflation that we have today, it's not a demand issue. Obviously, it's a supply, and the only way to reduce the increase of prices is increase production and have available all what is needed for producing cars and in what are the problems due to COVID in terms of the microchips and all these things. And in our countries is to start to produce food, be autonomous in energy, and it's a whole program that we have in order to depend less from the rest of the world. I want to be very short because I think I'm running out of time. Minsky is based on Keynes' uncertainty with a different view, Kalecki's increasing risk concept, and Fisher debt deflation. He also put forward the financial cycle related to investment spending. The difference here is that his main variable is the leverage rate and the financial debt structure of firms, which can create financial inflation on deflation. I think there is a famous phrase of Minsky: the deeper the cost of business cycle in an economy with the financial institution of capitalism is the instability of portfolios and financial interrelation. So the sequential relation goes, if there is a lot of uncertainty, there will be changing expectation about the future, there will be financial portfolio instability and income instability. Financial structure is that banks provide finance to firms, and here again, capital markets will annul back credit. It's financial innovation discussion. In developing economies, financial markets provided by external market, and here is the problem that we have in terms of spending and demand. To cut it short here, investment depends on the demand price, the supply price, demand price, and he put forward here a very important variable, which is the deviation of the debt structure in terms of a normal structure. And he argues that if investment increases, leverage rate increases, it deviates from a normal level. Borrowers and lenders' risk will increase, and perhaps they can move from covered to speculative and to Ponzi schemes. I'm not going to deal with this to just cover the last issue, and I will skip this one. If any question I can answer. I want just to finish with the circuitist, in which they put forward the issue of debt creation and destruction, the influx and reflux discussion. They argue that money is intrinsically endogenous, bank debts, and non-neutral. The rate of interest is a monetary variable set by the central banks that accommodates commercial banks' reserve requirements. Here, the argument is that the rate of interest is a distributive value, only affects the margin between profit and interest, not affects directly investment. Again, here the discussion that banks are, commercial banks are price takers whose interests are determined by the central bank, plus obviously a margin. Bank interests are considered pure rents with no resource counterpart, which means that it's not explained how interests go back to the productive sector. There are two here, there are two versions, the French version and the Italian version. I will keep only to the French version. When the influx phase, when it's money created, banks will accommodate demand of solvent borrowers. This will mean that bank credits will increase, bank deposit will increase, firms' debt will increase, and family income will also go up. In this sense, money is intrinsically linked to production, which is the efflux phase where money is extracted, is that families will spend their income, firms rise their income, and in so doing, they can annul or they can pay back to banks the debts, and the monetary circuit terminates. What is the central bank function? Accommodate commercial bank requirements, the lender of last resort, and the main disequilibrium factor at that central bank changes in the interest rate, especially if it expects profit margins. And there is a whole discussion of macro uncertainties and micro uncertainties, which I'm not going to deal with now. The last two things I want to show here is that the monetary circuit and the condition of reduced capital mobility is that banks will provide money to firms, firms will produce. In doing that, they will hire a workforce, household income will go up, and it will go back to firms by demand of households. Like this, they will pay back their credit. There is a discussion what happens with the interest paid to banks. There is, I think, a simple discussion in terms that all the interest will be paid back to workers that operate in the financial sector, and it will go back in the same way to annual credits. And also there is some saving of household that would go to the financial market, and this will allow some sort of spending of financing firms. This is a graph put forward by Secareccia, 12 and 13. But what happens in periods which are globalized? Here, financial capital markets are the main institution that operates in the financial market. And the issue here that households will be indebted with banks. Banks will their liquidity will be solved by the financial market through derivatives, and there is a whole discussion of how households will interlock with firms and how firms and here firms will create income for household and how does it annul. What the main argument here is that banks are not the main actors here. It's financial market, and firms in this case don't require finance for their activities. They actually lend money, and the main debtors here are the households. Let me finish with my conclusions. And here the main argument is that there have been two periods in Latin America. The easy period, which has been the industrialization period, the main problem of the monetary circus, that debts were not fully destroyed because on one hand, capital markets were underdeveloped and tax structure was extremely weak. And in addition, internal markets were small because wages were very low. Industrialization in Latin America took place in a context of high income and wealth concentration. In this period, the governments were responsible of investment expenditure through different means, public trust, development trust. There was a very important leakage through imports of capital goods and intermediate goods, and a lot of luxury capitalist consumption, which made that the industrialization period was an ongoing structural deficit. What are the shortcomings of the globalization period? I would argue that one is a very low investment coefficient. Investment spending has really dropped. Mexico, it's around 20% of GDP. It hasn't increased from the industrialization period, with the difference that foreign capital is the main finance source of this investment because it's done by foreign enterprises, and domestic capital markets remain very feeble. Again, the current account remains in deficit, and liquidity depends very much on foreign reserve, FDI, or portfolio investment. Therefore, economic growth is highly dependent on external events. I would leave it in at this moment, and I hope you have some questions and that I can answer. I will finish. Thank you. This will be my presentation.
Thank you so much. We are waiting for the questions.
I will stop sharing.
Okay.
I hope you could understand it.
No, it was, I mean, as for me, I've learned a lot. I've learned a lot of things that I perhaps should have learned 20 or even 30 years ago. Thank you very much. But one thing I want to ask you before we collect other questions. What is the circuitous theory of money? I mean, can you place it in terms of a general development of economics, say in 20th century or maybe 19th century? What are the origins and, let's say, the general idea, so to say, of the circuitous theory of money?
In Latin America or theoretical?
Well, theoretically, but of course, do you think that Latin America is specifically receptive to the theory or not? How do you think?
The circuitous money, I think, is the newest theory.
But it should have some connections with past theories, or not?
Yes, it has. In Latin America, you can start the discussion from the 19th century yeah, when industrialization started to be analyzed and how to finance it. The main problem in Latin America that we were developed in a very open economies. We didn't have this close, like the state, the situation in Russia, it can close with no problems and it can produce. Latin America cannot do it. Latin America started to industrialize through foreign capital, and it has never ended. Even in the industrialization period, the rules were set by foreign capital. So in this sense, why I did all this discussion, because you need state money to industrialize. You need state money for investment infrastructure. Yeah. Through the industrialization period was a closed economy, so the central bank, through the government, through the central bank, could finance it, and they used this concept of legal reserve requirement, which meant that the government spent money, threw it into the economy. There were no, the tax structure is very, very limited, so it didn't come back. What the government did is they imposed on banks that from each deposits, they needed to send some to the central bank. From 1 peso, percentage needed to go back to the central bank in long-term deposits. Now, like this, it controlled liquidity. Yeah, and obviously interest rates were set. I'm sort of telling you what I will say tomorrow, and exchange rate was very stable. So it could work, but it never worked perfect. But you had the external constraint because you constantly needed to increase more and more imports. This is all the discussion of that has been mentioned. I think Jan mentioned it on Friday about the Previous discussion and Ival Pinto's discussion in the 40s and 50s by ECLAC. Yeah, how to industrialize in an indigenous way, which hasn't happened in Latin America. So yes, what I would take from Kaletsky and the equities money is what the firms need. You need to circulate money. Here we have a problem because our financial markets have not developed as in the East Asia, which has been amazing how it has developed in comparison to Latin America. And we continually depend on what's going on in terms of the interest rate in the rest of the world and how much capital inflow comes into the economy. So I don't know if I didn't answer straight, but what I would say is, yes, it's a more circuitist theory that you can apply here. And however, you can also use, especially Keynes theory, in terms of money is determined by the state to use it in public spending. I don't know if I answered what you wanted.
I think yes. Thank you very much. Other questions, please. We have time, we have opportunity, and I think you should use it. Gunnet, please.
Oh, thank you. It's a very good lecture. Thank you, Prof. I did not get the 10 minutes of the lecture. I was doing some things in the house here. I hope my question was not covered in those earlier slides. My question relates to the point that you have just talked about now of industrialization in developing countries. I'm from South Africa as well, and we struggle from similar problems of foreign capital, which makes it impossible, which takes the terms and makes it impossible for any viable industrialization to take place. Now, Samir Amin has made proposals on industrialization for developing countries. He talks about a sovereign production system of manufacturing industries that produce consumer and capital goods that are locally created, with the state playing a key role. He also talks about agriculture as well, you know, that must have food sovereignty and food security. So he talks about delinking. He says all of this must be done in ways that delink. And he says delinking is not a complete autarky, but really to bring local factors to bear more in these industrialization projects, sovereign projects, he says. And he talks also a lot about exchange of capital and technologies between developing countries. He says it's more possible now than it was, say, 30 years ago. I mean, if we do a lot of trade with Russia, China, Brazil, as South Africa and Mexico, there's a lot of benefit, you know, that we'll get without even the big developed North countries. So what's your take on Samir Amin's theory of development for countries of the global South? Thank you.
I think today we are in a different situation. However, the problem remains. It's not a technical issue. It's not a problem of money issue. It's a problem of organization. It's a problem of social class alliances, I would say. Speaking in terms of Latin America, historically, external capital has allied with the rentists, which are the landowners, and prevented industrialization and endogenous industrialization to take place. So it's a problem of social classes alliances. Big foreign capital, but this has been since independence was acquired in Latin America. It has not been the case in Southeast Asia. It's interesting to read, in this case, Alice Amsden. She has about 2 or 3 books on South Asia in terms of Korea, and she has a book of also of Latin America, yeah, showing what were the problems. And I would argue, because of that, I just put the theory, money is important, money is available. You need the right financial organization, and you need the determination of doing that. In Latin America, Mexico is the case, Chile also is the case. You started with industrialization in very high technological goods, cars. The white line, which is fridges, all was in the 40s, 50s, production was made, some home appliances, all this, yeah? And you never, you covered only final consumption. You never covered intermediate goods and capital goods. I think in Russia was the reverse. It looks that the problem was at the other end, what I understand of what I studied for what happened there. However, in Latin America, I would say that the problem is a political issue, a problem of class interest, in which the domestic dynamic capitalism capitalist hasn't been able to win the war or to impose their interest. In this sense, I think this paper by Calder in 1959 is very interesting. And there is another one of Kaletsky, I think 54 in terms of Mexico. The problem has been that it didn't go back to the whole chain of production. And when you got in Latin America, big country, industrializing much more than the others, which was Brazil in the 60s, it played a role of a sub-imperialism, which we called imposing interest of foreign capital to Brazil, to the other economies. The interaction between developing countries in Latin America, there are lots and lots of projects haven't been able to take place. And again, it's not a problem of liquidity. It's not a problem of the monetary sector, because you need to have an organization. What I argue is that they never were able to organize into a more deep financial crisis. We have capital markets in Latin America, Peru, and Mexico around 1880, 1870. It's a long time we have capital markets which have never been used or very little used, or their interests are linked to the financial center. There is also an interesting note about Rosa Luxemburgo of how she analyzed this the relation between the financial markets in Latin America and England, yeah, which were completely under the hegemony of the big capital. I think here we cannot lose that part of the side. So when I look through the economic theory, yes, it operates very well. The problem is organization, and the problem is not the problem of willingness or not willingness. The problem is to impose the interest of an economic, an endogenous economic growth. This is my view. I will go much more in tomorrow to show what happened, what is the situation of Mexico today in terms the main, the productive tax, the external account, and etc., to show what is the monetary policy today, which is completely, it supports big capital interests. Commercial banks, private commercial banks, they own about 80% of the banking assets of Mexico, are the most beneficiaries of the monetary policy today. So this makes you that, again, it's a problem of distributive, yeah, that goes against endogenous economic growth. This is my stand, yeah, in terms, and obviously today you cannot, I don't think we can go back to closed economies. It's impossible, yeah, because it's, you take TEMEC or what was NAFTA from Mexico today, and you will have an uprising, because all the North depends on that. The problem is only staying with that. In this sense, I completely agree with you. We need alimentary, food autonomy, energy autonomy. Now it's very important, the sanitary autonomy. We cannot depend on vaccines from the United States because they just won't give it. Or they will limit it. For instance, to the people who got the vaccine, the Sputnik vaccine, cannot travel to the US because it's not recognized. It's not recognized. It's a geopolitical issue. If we have our vaccine, we don't have problems.
Okay, thank you very much.
My answer.
Thank you very much. We have another question, but before there is a comment in chat on Carabelli. The origin of circuit theory is Keynes's treatise on money and Schumpeter's theory of credit. Can you comment on this? Agree?
Yeah. You can, if you read the treatise of money, you get the basic of it. And obviously in Schumpeter, I completely agree with it. But I'm thinking in terms of how it was imposed. Sorry, perhaps I didn't got exact your question, but when I answered, I tried to think how it has been imposed, how it has been used in our economies. Obviously, theoretically, yeah, we can read, especially between chapter 1, 2, and 3 from the volume 1 Treatise of Money, how Keynes deals with that. It's completely true. And we can go even further with the banking school versus the fiduciary school. Yeah, I would agree completely, sign up completely what Professor Carabelli says. Completely agree. Yeah, but my answer was in terms how it was used in Latin America. It has always been linked to foreign capital, even in the periods of closed economies.
Okay, thank you. And David, please, your question.
Hello, Professor. Thank you very much for the lecture and again, organization. It was a pleasure, honor, and to listen to your lecture because I'm also from Turkmenistan, a Central Asia country. It is developing country, so that's why I'm also particularly interested in the topic you are raising today. And because Professor, so from what I understood, you are arguing that monetary mechanism of Latin Americas is ill-biased against unequal distribution. So as if you are arguing that it should be corrected. So if it is mended, then things will go well. That is, we will have relatively equal distribution and economic growth as well. And because also I completely agree with you that with current terms, it is financiers, banks, and certain classes are benefiting from that, foreign capital and ongoing monetary economic system. To that end, my question is, because we have witnessed from history how these things changed, for example, with respect to Russia, Tsar Russia, I mean, it was sort of a backward empire, if I might so call, agricultural empire. And then as, I'm not favoring communists, but certain things they came up with, industrialization, the Soviet Union became like a power state, right? But again, there was not that soft evolution. There had to be revolution, unfortunately. Or for example, in Poland, because I live in Poland, there was also sort of revolution to break from communism, Solidarność, they call it here. And to what do you think it is possible to go with soft evolution so that monetary economic system changes, that certain classes evolve to the classes that really care about nations, or there has to be a reset? Thank you.
Difficult to answer. Myself, I'm originally from Chile.
Okay.
We tried to, Chile in 1973, as you know, it was a big coup d'etat, also known Latin America, South Cone, and they tried to do a Pacific change. They call it the Chilean road to socialism. And they tried to do the same thing in Argentina, they tried to do in Brazil. And the main problem of that period was that industrial capitalists tried to open their spaces against landlord and foreign interests. It was a closed economy in which foreign investment came in with a competition that did not allow domestic entrepreneurs to develop. The car industry was the best example. In what terms? There was a lot of foreign companies doing cars in specifically, I think was Mexico and Chile. And when the car industry owners, domestic, went to the government and said, look, we need some help. We need special terms to compete with foreign markets. They say, no, we cannot do it against these foreigners. And obviously, landlords made their food prices high. It limited industrialization. So, and again, all these popular movements in the southern corners of the country were swapped, were killed by these coup d'etats. It wasn't that socialism was going to impose. No, it was against the popular endogenous economic growth that were fighting with the big classes, with the interest classes. I would regard it like that. Today in Mexico, we have a sort of government with Andrés Manuel López Obrador that promises that it can attain development on a different equality basis. He's doing things, yes, he's doing things. But the amount of poverty that we have in Mexico, in extreme poverty, it's about 30% of the population. In poverty, it's about 50. And now with COVID, it's much worse. We can say we have done a bit better than our partners in Latin America, yeah, because the government didn't got in debt to save the big enterprises, because at the beginning of the pandemic, yeah, they were shouting, we need money to keep the workers in place. We know it's not true. It happened in 1994. We need money, and they were rescued after the big crisis in 1994. Yeah, and they become bigger. One of the problems, I think, in this sense, for me, was very important to read Caldor. Yeah, yeah. The government can step in, can have very good ideas of infrastructure, but if the upper class doesn't pay taxes for what is not going back to the productive sector, we have a problem. Yeah, and the tax structure in Latin America is well below OECD structure, and particularly Mexico, which has the lower tax revenue of all Latin America, and the amount of evasion and illusion, which is legal evasion, is enormously. Now, to give an example, in this government, they decided that everyone who needs to pay taxes will do it, and actually it has been done. With no tax reform, I think the government income went up by 3 or 4 points of GDP, which is a lot. Yeah. So again, my argument is, I went through the theory saying the main problem here is the financial organization. We need banks giving money. We need banks not having high profits, limiting their commissions, reducing bank interests. I'm not saying that they wouldn't earn, but if you take BBVA, which is a Spanish bank, Mexico, we have done that, Mexico, Spain, the amount of returns which is imposed here is much higher than in Spain. Actually, we are sending money to the company, the center company. See, so what I'm arguing is money is important. Of course, it's important. Financial organization is extremely important. Yeah, we need to issue finance in domestic money, which hasn't happened. Yeah, and when it happened in the period of industrialization, because external money or capital inflows coming to Mexico was from government credits, there was no private capital movement at that point. Yeah, you got all the leakages through external to current account deficit. So what I'm arguing is, again, there was a leakage. I gave one of my papers to review, and they were saying, okay, to the industrialization period, you need to have structural deficit. I wonder, we cannot have the structural deficit as we had it in terms of capital goods and intermediate goods. If we learn from Korea, if we learn from this part of the world, I'm not saying that they're perfect, I'm not saying that they will follow. Every country has its own history and its structure. But if you start to produce from simple goods to more advanced goods, the dependencies will be less. Yeah, and this I think is very important. Yeah, you need to see. So answering to Anna, answering to you, money need not be a problem. The problem is financial organization. The problem is how to destroy debt. I would prefer more Kaletsky's view in this sense. You need to impose domestic money, you need financial structures, and you need to have a tax structure to avoid such a concentration of income and wealth. And for not being sure, making that idle capital, you won't get a lot of returns on that. This would be my argument. So again, I'm using the theory, yeah, because you can use the neoclassical theory. Interest rate is a real, yes, it doesn't work like that. We know it's a monetary variable. It's a distributive variable. We know that. And like because of that, I like so much, whatchamacallit, I like so much Kaletsky in these terms. So I would argue that there is a social conflict, a social problem of the alliances of the big capital, and this needs to be broken by domestic entrepreneurs. I don't know if it can do it. Yeah, in Latin America, there is a theory by the dependentistas, led by Rimauro Marini, Teotonio dos Santos, and all these people who say, we don't have a national bourgeoisie. I don't believe that. But this discussion has been done here. I don't know if I've taken too much time in answering you, but this is my view.
Thank you very much for open answer. Thank you.
Thank you very much indeed. We have run out of time on this lecture, and Professor Levy.
Sorry.
No, I mean, it was our job and our pleasure, because you brilliantly, in my view, connected deep theoretical insights with your views, let's say, on the problems of economic development, and it was really really very good to listen to, in fact. So let us thank Professor Levy, and let us meet tomorrow at the same time. Thank you very
Okay,
much.
thank you very much. Thanks to you for listening.
Thank you.
Goodbye.
Bye.